Today, we're digging into a real head-scratcher based on a new analyst report on PayPal. On one hand, the company's business is absolutely on fire. Earnings are way up. But on the other, its stock is, well, tanking. So we're going to unpack this massive disconnect.
Right, so how can a company be crushing it from a business perspective while its stock is just stuck in the mud? To really get to the bottom of this, we've got to look at both sides of the coin, starting with all the reasons to be optimistic about PayPal.
Okay, first, let's look at the bull case. That's the optimistic view, right? The argument for why this stock should be going up. And the evidence here starts with some incredibly strong performance numbers that paint a really clear picture of a healthy, growing company. So check this out. The first piece of the puzzle. PayPal's earnings per share have jumped almost 20% year over year. Now, that's not just a little bump. It's a huge signal that the core business is humming along, it's profitable, and it's expanding at a really impressive clip. But it gets even more interesting when you put that number in context. See, PayPal isn't just growing on its own, it's absolutely blowing past the competition. Over the period this report looked at, its earnings growth just completely dwarfs the rest of the S&P 500 and even its own financial sector. That is some serious outperformance. And this isn't just some look back at the past either. We're talking recent performance. The company's latest quarterly report showed it beat earnings expectations by over 10%. And maybe even more important, management actually raised their forecast for the rest of the year. That's a huge vote of confidence in where things are headed. So that's the bull case, and it looks pretty strong, right? But now for the other side of the story. If the business is doing so well, why is the market so darn skeptical? Let's dive into the concerns that are really weighing this stock down. And boom, this number right here just perfectly illustrates the paradox. Despite all that amazing earnings growth we just saw, the stock has been heading in the wrong direction, dropping over 9% in the last 6 months. This is the disconnect. This is the puzzle we're trying to solve. So what's causing it? Well, there are two big red flags. First, a recent analyst downgrade. That's when a big financial firm basically says, we're not as excited about this stock as we used to be. And second, and this one's pretty telling, executives at PayPal are not buying their own stock. In fact, all the recent insider trades have been them selling shares, which, is never a great confidence booster for investors. Okay, so we've got this battle going on. Strong fundamentals on one side and weak stock price with some concerning signals on the other. How do we make sense of it? Well, according to this analyst report, the answer lies in one key idea: valuation. Now, before we get to the big number, let's just quickly talk about the PE ratio. It's one of the simplest ways to see if a stock is cheap or expensive. A high PE means you're paying a lot for the company's profits. A low PE might mean you're getting a bargain. It's basically the company's price tag. So here's the kicker. PayPal's price tag is sitting just under 14. Meanwhile, the price tag for the average company in the S&P 500 is almost double that at nearly 28. What that means is you're paying 50% less for every single dollar of PayPal's earnings than you would for the average stock. That is a massive, massive discount. And this right here is the analyst's big aha moment. The argument in the report is that the market has just gotten this totally wrong. It has punished the stock way too much for those red flags. And in doing so, it created this huge discount while ignoring the fantastic earnings growth. The analyst is betting this isn't a trap, it's a rare opportunity. So with the mystery now framed as this big valuation gap, the report doesn't just stop there. It actually lays out a very specific, disciplined game plan for how an investor could potentially act on this insight. So the official recommendation is to accumulate the stock. Now, that doesn't mean you just rush in and buy your entire position all at once. It's about building a position over time, and the report is super specific about how you might do that. The whole strategy here is about being disciplined. It suggests starting with a small position now, but then saving the bulk of your investment for a slightly lower price. And maybe most importantly, it sets a clear exit point, a stop loss, which is an automatic sell order. That's how you manage your risk in case the whole analysis turns out to be wrong. Okay, so what about the reward? What's the potential payoff? Well, this table lays it out really nicely. Even the most conservative scenario is targeting a solid double-digit return. But the analyst's base case, what they think is most likely to happen, is for the stock to rise somewhere between 23 and 30% over the next year, all as the market starts to notice those strong earnings and that cheap valuation. So, to wrap it all up, the report's conclusion is that PayPal's powerful growth in its low valuation make it a really compelling contrarian play,
That's an investment that goes against what most of the market is thinking. And the final question it leaves us with is a big one. Has the market correctly identified a value trap here? Or has all this pessimism created a rare chance to buy incredible growth at a 50% discount? According to this one analyst, the answer is pretty clear.